Hello, Velocity Channel family. Welcome back to another video where we bridge the gap between financial freedom and non-financial freedom. Today, we're going to be diving into a hot topic, velocity banking versus the extra payments. Now, listen, we are not going to be controversial. We just want to convince you by the numbers, nothing else, all right? And so, which one is better to you? Is it the strategy for the extra payments or velocity banking? We're going to let you decide. Without further ado, I want you to like, share, and subscribe, and get ready because we're going to show you how velocity banking and the extra payments, what the comparison is, and how velocity banking wins out or not. All right. First, let's talk about velocity banking, right? What is it? This is a strategy it can involve, right, using a line of credit to pay off your loans faster. That's the most popular method. Doesn't always have to be that way, right? But it's like running a marathon with a jetpack. But how does it work, right? Well, it's all about leveraging your income and reducing your interest payments. And what we want to do is we want to break that down into an example right now. So check this out. So just to recap, we want to make sure that we understand velocity banking in the correct way. We have different scenarios, don't we? We have different expenses that we have as human beings. So we have the car at $600 a month, the groceries at $1,200 each month, the $600 credit card payment, minimum monthly payment, right? The loan, or is it though, right? For the mortgage at $1,200 each month because the purchase price was $200,000 or the loan amount was $200,000 at 6%. It's going to be closer to $1,199.10. However, we round it up to $1,200 each month you're paying on that. And then, of course, you pay back $1,400 each month, perhaps to the DOA accounts, otherwise known as IRAs or savings accounts. Is it a savings account? Are you saving anything, right? Or are you losing money when that money is continuing to be in that account? You be the judge. But right here is how we were taught from our youth to divide up our income, right? Segregating the income. Listen, that just sounds wrong, right? Income segregation. Didn't we get rid of segregation already? So we want to make sure that we got rid of segregation here as well. How? By making sure that when the money comes in, the income comes in, it goes into the credit card. That way, you don't have to worry about a minimum monthly payment. Why? Because you're placing that $5,000, let's say you get that in income each month, into the credit card. And when you put your income inside your credit card like that, what's your minimum monthly payment? Huh? Okay, so your minimum monthly payment, you don't have to worry about. That means that $600 goes in here, right? You see how I did that? That's some Bob Ross stuff right there. $600 is the cash flow now, and that you can do with anything. So look, you can do it with a line of credit. You can do it without a line of credit. You can do it with your IRA, with your savings account. You can do it with a plethora of things. But what I want you to realize is that it's all about leveraging that income, making sure that when you have that line of credit full, that you are chunking away at this principal, because the principal is the host and the interest is the parasite. Thank you, Jesus, for reminding me of that. He said, man, remember, you got to let the people know about how powerful it is to chunk the principal. And that is the power of velocity banking. So look how instantly, when you change where your money's going, financial allocation, keyword being location, right? When you place your income inside of that line of credit, guess what? You no longer have to worry about the $600 each month because you have it inside of your line of credit that now you control that, right? That $600. You decide what to do with that $600. All right. And if I were you, I'd go ahead and invest it in the best investment, which is yourself. Listen, let's go forward to the extra payments. All right. So now what we're going to do is we're actually going to switch gears and talk about extra payments. Now, this strategy is as straightforward as it sounds, right? You've heard it. 15-year mortgages, right? You simply make additional payments towards your debt above and beyond your regular minimum monthly payments. So it's like taking the stairs two at a time. But what are the benefits of this approach? Are you ready to go ahead and dive in? Let's go ahead and dive into the benefits of that approach, okay? All right, so we've talked about some of the benefits of velocity banking. Let's talk about the benefits of making extra payments, where you're talking about a payday loan, where you're talking about a car loan, where you're talking about a mortgage. The benefits of making an extra payment on your loans is the lender can get really, really happy, because those loans are, especially on the mortgage side, they're front end loaded. All right. Now, folks, listen. 1,200 plus 1,200. Let's just do that out there. That would equal $2,400 each month. Now, are you going to be able to pay off your mortgage in about 15 years instead of the regular 30 years? Yes. But the cash flow, right, is going to be going away from you, and that's the issue that I have with that. Now, I would love for anyone else to give me a benefit of extra payments over the velocity banking concept, except you are comfortable in what you understand. Oh, come on. I think that now I may be wrong, but please comment below. Let me know. Give me some feedback. The only benefit in making extra payments over velocity banking, look, is that you feel comfortable, right? You get to sit in what you feel comfortable, and that is making extra payments and leaving the credit card to continue to do as it is. Now, you may say, yeah, but CJ, I don't believe in credit cards. And that's great. I'm so thankful for you. But listen, we got a system. Okay? Remember, solar system. Remember, cardiovascular system, right? Respiratory system. If you need to work it well and you need to work it intelligently, you've got to have a system. All right? And that system will automate velocity banking for you. It'll make sure that this credit card is used to its maximum. Absolutely, to its maximum capacity. It'll make sure that your IRAs and that your groceries and even that your mortgage is paid off in not 15 years, but in as little as 5 to 10 years, right? And so what we want you to do is just look at the numbers. Is it better? 1,200 plus 1,200. So you're going to be paying more each month instead of using wisely this line of credit. I mean, you got the 15,000, right? Some of you, it's going to be unsecured. So guess what? The money's not yours anyway. So you might as well use it wisely. Let the lenders know how you know how to use money, and chunk this principal down. That way you can chunk the interest down. That way there's more going to principal. That way you can pay this off. You see, the sooner you pay these loans off, these consuming loans off, the faster you can pay you. The faster you can invest in you. Okay? That's what it's all about. It's not about sending more money somewhere else and having no leverage, right? But it's all about using what we have to the maximum capacity. And so, listen, if you have a question on that, please let me know. Because the only benefit that I see in extra payments is that you get to pay extra to your lender. And I'm sure they give you coffee cups, they give you treats, maybe doggy treats even, and they maybe even buy you dinner. Maybe they even call you up and say hello to the family. What I want you to do is I want you to exercise intelligence for yourself and see if there isn't a better way. Please come talk to us. Thank you so much for tuning in. We do have the answer to the madness of paying someone else extra all the time, and that is the Money Max account. God bless you, and you take care.